It's time for Yahoo Finance's Market Minute. Stocks plunging as tariffs on Canada, Mexico, and China go into effect. Nvidia shares extending declines today after falling more than 8% Monday, hitting its lowest level since September amid tariff woes and potential trade export restrictions. Target under pressure after the retailer warned that uncertain consumer demand and tariffs could weigh on its next quarter. Target's fourth quarter did blow past Wall Street's expectations thanks to stronger than expected sales in its discretionary categories over the holidays. Also, Okta shares jumping on better than expected fourth quarter earnings and revenue. The company's CEO told Yahoo Finance that identity and security are very important for companies and governments, which will be exciting for Okta's next year and beyond, according to them. That is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR below where you can track the best and worst performing stocks of the session. Welcome to Wealth. I'm Madison Mills, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks to grow your money. On today's show, stocks under pressure as President Trump's tariffs on Canada, Mexico, and China spark retaliatory tariffs. We'll discuss strategies and help you insulate your portfolio from the volatility. We'll also dig into the items you use every day that could be impacted by those tariffs. We'll talk to an expert about when to expect an impact on your wallet. Plus, hosts of Yahoo Finance's Living Not So Fabulously will join the program to give you 3 ways to save up for a down payment in an expensive housing market. Well, President Donald Trump's tariffs on Canada and Mexico, plus that additional tariff on China officially going into effect this morning. All goods imported into the U.S. from Canada and Mexico will have 25% tariffs, imports from China totaling 20%. So how do tariffs impact prices? Like a lot of things, it comes down to supply and demand. If consumers want something badly enough and companies know it, they might pass on the full cost to their consumers. But if there's plenty of supply and consumers can take their money anywhere, they may stick with products coming from companies that find a way to keep their costs low. Let's say there's a 10% tariff on imported goods. Does that mean you're going to pay exactly 10% more? Not always, right? One example, tablecloths from India. A 10% tariff would likely only raise prices about 2% because tablecloths are made everywhere. If India's get pricey, stores just buy them from other countries. That competition keeps prices low. Then we've got another example, gaming consoles. If a PlayStation made in China gets hit with a 10% tariff, you will potentially pay exactly 10% more because there's no real alternative. You're not switching to an off-brand console that gives Sony, Microsoft, and Nintendo the power to make you eat the full cost. Now, it doesn't stop there. If tariffs hit Mexican-made cars, it's not just those cars that get pricier. Dealers could raise prices on all their cars to keep margins high. The same thing happened with washing machines and even dryers when tariffs hit appliances in 2018. Now, China retaliating against U.S. tariffs, adding 15% to U.S. farm equipment. China accounts for a large chunk of U.S. agricultural exports, 17%, according to the Department of Agriculture. Equipment manufacturers will then potentially raise prices for all of their products, putting grocery prices at risk of rising even more than they already have. Bottom line, tariffs don't just add prices. Companies use them to reshape prices across the board. We're going to have more tariff coverage for you throughout our hour, including the impact on gas prices and the housing market. But first, let's take a look at the market action 90 minutes into the trading day. One big headline we are monitoring, stocks reversing the rally that we saw following the election of President Trump. You can see here your S&P 500 hovering around 57.55. That's also nearing the 200-day moving average. So questions about whether or not we see more selling once it hits that. Again, this comes as the global trade war escalates. U.S. tariffs of 25% on Mexico and Canada taking effect. Joining me to discuss, we've got David Dietz with Dietz Wealth Management Group's Chief Investment Strategist. David, thank you for joining me here this morning. What are some strategies for investors to navigate the volatility and uncertainty presented by tariffs?
Sure. I think 2 key strategies. One is stay diversified here. We have seen, of course, people make big profits in the Mag 7 and so forth. But when you look really year to date, that's where all the losses have been, while other areas that people perhaps have taken a light touch within their portfolios, for example, international diversification, Europe stocks are up over 10%. So down 7 in Mag 7, up 10 in the European stocks. You could mitigate a lot of that down 7 if you included some of that. So that's one thing. Of course, always remember the fixed income component in your portfolio. We've seen, for example, the 10-year Treasury drop in yield about 40 basis points since the start of the year. Yields come down, that means prices go up. So that's another bulwark for your portfolio. I think the other key thing investors need to keep in mind is don't react too quickly. We have seen all sorts of instances just since the inauguration day of kind of flip-flopping on strategies. The tariffs against Canada and Mexico were on, then they were postponed for 30 days. Things can change very, very rapidly. And so particularly those who have a investment horizon more than a nanosecond, be cautious about reacting to every single twist and turn in the headlines.
Well, there's this idea in the market that corporate tax cuts could be a little bit of a cushion to some of the selling that we are seeing off the back of those tariffs. Do you think that the market will react positively if and when we do get confirmation of those continued tax cuts, or is it not the same cushion that it was in 2018?
Well, since they're already in effect, and
Right.
it's merely an extension of the pre-existing corporate tax rates, I don't think you're going to get the same sort of bang for your buck as we did back in Trump 1.0. But nevertheless, it will be helpful. We're looking at other tax provisions, too, that could be useful for consumers. For example, perhaps the lifting of the SALT cap, which could help consumers in high tax states. And of course, there's other little things, on tips and so forth that could also help other consumers and so forth. But I don't think we're going to have a huge tailwind from the extension of the corporate tax cuts.
So what's your single best trade idea for the next year for investors who want to hedge against any risk from policy uncertainty?
Well, again, stay diversified. Certainly, dividend-paying stocks can make all the sense in the world here because those have lagged behind really for the last decade as people are ignoring yields 3, 4, 5% per year, which are growing with earnings as they've chased the non-dividend paying tech stocks. But if in fact this economy slows, and there's every reason to think that the policy volatility along with tariffs will cause a slowing in the economy, then interest rates continue to come down. And of course, the value of dividends, and of course, even more importantly, dividends are growing, is going to be worth that much more. So that's a general theme that I think investors could pursue.
And what about SMCI? This is one of your top picks. It's been a fascinating stock to monitor here. It's down about 30% in the last 5 days, but has seen a run up year to date here. What's your base case and your bull case for SMCI?
Yeah. So what I love about MCI is they're making some of the hardware and servers that are going to help further the AI revolution. In fact, Nvidia at one of their investor conferences particularly cited SMCI Supermicro as an important partner as we build out the AI infrastructure here. But the stock, of course, had some issues. First of all, it got way up into the stratosphere at about 122. And then, of course, they had some accounting difficulties. They fired their auditors. There was a chance of delisting. That seems to be past them. In fact, they finally got that problem resolved. But the stock pulled back about 13% yesterday. It is up today, and as you know, a very ugly tape here. And what I like about Supermicro is the growth is fantastic. The debt is low. The accounting problems seem to be in the rearview mirror, and you're buying something that's trading at about 12 times earnings instead of 12 times sales, which is pretty good in the AI environment.
All right, David, we got to leave it there. Thank you so much for joining us. Appreciate it. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, On Holdings beating on the top and bottom line in the fourth quarter, reporting 36% sales growth from the prior year. Sales outlook for the full year essentially meeting expectations. KeyBank calling those results better than expected. Truist saying the results and outlook cleared a high bar and touted underlying demand trends. Citi calling the results a big beat and thinks the sales outlook is conservative. That stock up 3%. Next up, AutoZone missing on the top and bottom line in the second quarter. Comp sales rising 0.5%, but falling short of analyst expectations for 1% growth. There's a big drag from international comp sales falling 8.2%. CEO saying currency rate moves pressured sales and earnings in the international business. And finally, we'll flip it over to Kraft Heinz, known for its ketchup and mac and cheese, of course, entering the alcoholic beverage market. The company rolling out a new hard seltzer with Crystal Light. Kraft Heinz says nearly 1 in 5 Crystal Light fans already use the product as a mixer for their cocktails. The vodka refreshers are 77 calories with 0 sugar. They'll hit shelves this month at select retailers, costing $9.99 for a 4-pack. The company expects new flavors and multi-pack options in 2026. That stock up 1%, which is bucking the broader trend of selling that we are seeing in a lot of these consumer-facing names this morning. Well, tariff woes and weak economic data have driven volatility over the past few weeks. Just because the headline indices have given up all their year-to-date gains, this doesn't mean there isn't value to be found in the market. Joining me now to talk about that, we've got Michael Sonnenfeld. He is the founder and chairman of Tiger 21. It's a peer membership organization for ultra high net worth investors. Michael, it's great to speak with you because you can give us such a great pulse on what the ultra wealthy are thinking about this market. Just give me the headline here. How are you hearing investors talk about this kind of rise in pessimism we're seeing in the market versus where the market's currently at?
More turmoil and confusion than normal. It's a period of great volatility. And our members are not just ultra high net worth, they're all former entrepreneurs who have built businesses mostly from scratch. The overwhelming number of our 1,600 members are first generation wealth creators. So they've been creating wealth in the private markets primarily.
And talk to me about why value investing is being viewed as the right way to allocate capital right now.
So value is seen in a lot of different ways. Our asset allocation has over half of our members' assets, about $200 billion collectively, in private equity and private real estate. That's where members are finding a lot of value. We only have about a 23% exposure to the public equity and mostly in the ETF. But there's some trends that people notice. For instance, we had a low cash in the fourth quarter. The last time we had below 10%, it's 9% now, was in 2007. So it's a little reminiscent. Same thing happened with Berkshire Hathaway.
Right.
They have the highest cash now, and they had the highest cash right before 2007. You can look at housing starts as an indicator, or houses for sale. So there's a lot of indicators saying there's a rotation in the market out of growth and into value. You can play it on ETFs. You have the Russell 2000, you have IJS, but those are really defensive moves. The thing that our members know is if you're buying a company, forget the momentum. On average, look at the fundamentals. It's a company, you're buying a piece of it. How will it do? Our members are very meat and potatoes oriented of basics. And this is a time where basics are really going to shine through.
So it also sounds like you're saying it's a stock picker's market a little bit.
Well, it's always a stock picker's market if you can pick great stocks. But over the long term, the evidence is overwhelming that indexes in buying the market is the better play for the long term. Some people aren't thinking the long term, they're thinking the short term.
Right. Well, and it's interesting hearing you talk about small caps, but they're off their highs, down 15% today since November. So it is a challenging environment to find that value. I also heard you talk about private credit opportunities. How can retail investors play that area of the market?
Well, there are a number of publicly traded private credit companies. The BDCs in particular, Golub would be one that's widely held among Tiger members, but there are many. I think Blackstone has one and many others. So as a category, when you're talking about value investing, depending how you look at it, the fact that a loan is at a proportion of the value, you're already having the protection of the equity above the loan. So if you really want some downside protection, if you can get private credit where the credit is independent, meaning it's floating credit, not taking the interest rate risk, that might be a better play.
What's your highest conviction trade amid this policy uncertainty?
staying away from the fads. Our members are in private credit, our members are in private real estate, anything that's sort of meat and potatoes. Apartment houses would be a good example.
I'm not hearing AI, I'm not hearing tech.
We have a huge exposure to AI. The Magnificent Seven has been on our radar for the last 3 years. Obviously, it's down about 10% this year. But when you say down 10%, it was up 60% last year. So it depends when you focus in that lens, how closely are you looking? And when our members get in our meetings and somebody says, well, it's down 10%, what should I do? They say, well, if you didn't know that it's a better deal when it's down 10%, you shouldn't own it in the first place. But if you look at a longer term perspective, the Magnificent Seven still have extraordinary franchises, even though there seems to be some sector rotation out of that.
I like that mentality. If you wouldn't buy the dip, then you're not high conviction enough to own that individual name. Thank you so much for joining us and breaking that down. Really appreciate it. We're going to do a quick check of the major averages as we're still seeing that selling happening off the back of those tariff announcements. You're taking a look at the Dow, still under pressure, though recovering from some of the degree of losses that we did see earlier today. I also want to see if we can get a check on the S&P 500 and the tech-heavy NASDAQ here. Still seeing those losses. Again, the S&P 500 capitulating all of the gains that we have seen following the election of President Trump. You've got your S&P down 1.5%, your tech-heavy NASDAQ down about 1.3%. After the break, we're going to discuss when consumers can expect tariffs to hit their wallets and the specific impact on gas prices and the housing market. Stay tuned for all of that next. Importing goods into the U.S. just got more expensive, and exporting them to other countries is about to cost more as well. President Donald Trump imposing 25% tariffs on all goods coming in from Canada and Mexico, our closest trade partners. Also imposing an additional 10% tariff on China on top of the 10% one added back in February. Now Mexico, China, and Canada are all planning to retaliate. So what does this mean for consumers? Joining me now to discuss, we've got Paul Gruenwald, Chief Global Economist at S&P Global Ratings. Paul, it's great to speak with you. Help me break this down for consumers monitoring these headlines coming in. Is the tariff tit for tat that we are continuing to see something that is actually going to hit consumers' wallets in the near term?
Yeah, thanks, Madison. Great to be on the show. Yeah, the first issue to think about with the tariffs is who's ultimately going to pay them. Obviously, tariff, but we try to look historically who's paid these, and we keep coming back to the same answer, which is ultimately it's the consumers in the the tariff issuing countries. So in this case, it looks like most of the tariffs are going to be passed on to U.S. consumers. So when you put that together, we've got a revised forecast now that's got a bit lower growth, a bit higher unemployment, and a bit higher inflation reflecting that.
And where does that leave your outlook in terms of the likelihood of a recession?
Yeah, in the U.S., it might be kind of marginal, maybe 20 basis points, because the U.S. is a relatively large economy and it's not very trade dependent. But our trading partners, Mexico and Canada, they are likely to go into recession with reductions in growth on the order of 1 to 2 percentage points. So again, kind of on impact, it looks manageable for the U.S. What we're really worried about is this uptick in uncertainty. And if that starts to affect firms' investment decisions and consumers' spending decisions, then we could be in for kind of a bumpier ride in the U.S.
Yeah, I'm fascinated by this idea of whether or not we can sort of talk ourselves into a recession by talking about policy risk, by increasing fear in the market. And we're seeing a key fear gauge hitting a record high this morning as well. Have you seen that happen throughout your career, this idea of uncertainty and fear about the market leading to a recession?
It's pretty rare. We have a couple of recent examples where the Fed's U.S. policy uncertainty index has spiked. One of them was at the beginning of 2009 when we entered the global financial crisis, and the second one was March 2020 when we entered the pandemic, and policymakers were understandably at a bit of a loss back then as to what to do. The index spiked again in 2025, January and February. So if this does indeed lead to a pullback in spending, it would be kind of an own goal. It doesn't necessarily mean recession, but it's kind of an avoidable slowdown in growth. We'll be revising our forecast later this month, but we've definitely come to the view already that the downside risks to our baseline soft landing scenario have risen.
And how are you thinking about the Fed moving forward and whether or not they will be more willing to take policy from the White House into account when they're deciding whether or not to cut rates this year?
Right. Well, Jerome Powell's been pretty clear that the Fed's independent, right? It's independent within the government. It's not some external organization. It's part of the government, and its mandate is set by Congress. But I think what's interesting about the Fed is most of us economists were thinking that going into this year, the Trump administration would try to juice up growth a bit. Inflation expectations came up. So we took a couple of Fed rate cuts off the table. We went from 3 to 1. Now with this new downside risk on the uncertainty we just discussed, we can see the bond markets reacting, the 10 years down to 4.1, 4.2. There's a possibility that with the growth slowdown, those Fed rate cuts might come back on the table. That's not what you want, because that would be signaling a serious slowdown in growth and, possibly a recession. Also would be a weaker dollar. So that's kind of the trade-offs we're looking at right now, whether this uncertainty is really going to move the macro needle downward in a big way.
All right, Paul, really appreciate you making time for us this morning and breaking that down for us. Thanks so much.
Thanks very much.
Well, President Trump implementing a 10% tariff on Canadian energy imported to the U.S. How could that impact how much you pay for gas? Here with more, we got Yahoo Finance senior markets reporter Inez Ferre. Hey, Inez.
Hey, Madison. And some states could see prices rise as early as today, according to one analyst. Specifically, the regions that are going to be impacted, that'll be between now and the next 3 weeks. And specifically, you've got the Northeast. This is the area that will be impacted the most. You've got Patrick DeHaan of Gas Buddy predicting that you're going to be seeing gas prices anywhere between 20 cents to 40% higher by mid-March. And the Northeast is really the area that's impacted because that is the area where you're getting a lot of imports from Canada that are refined fuels. So we're talking gasoline, we're talking jet fuel, we're talking diesel. So that's directly coming into the Northeast area. The other region that is going to be impacted is the Rockies region, the Great Lakes. And that is because you are getting in this region, you're getting directly the crude imports from Canada. And the U.S. imports about 4 million barrels of crude per day. And that is heavy crude that is used in the refineries in these regions. So those refineries run on that heavy crude. They need that heavy crude. They can't just switch over to something else. So that'll be one challenge going forward. But that is something that is likely to impact prices in the weeks to come. Goldman Sachs is saying that they're predicting that basically the Canadian oil companies and the U.S. consumers, they will be bearing the brunt of these tariffs. Why the Canadian companies? Well, because Canada can't necessarily, it's not that easy for them to export their oil, their heavy crude, to other markets. This is because of the infrastructure that they have built. These are coming through pipelines into the U.S. So it's going to be difficult for them to do that. So Goldman Sachs is predicting that they're going to be lowering their price of crude, their Canadian price of crude. And then on top of that, you're going to have the U.S. consumer that is also going to be paying a little bit more for these gasoline prices. But make no mistake, analysts are saying that if we do go into an economic downturn, into some type of recession or slowdown, then you are going to see demand going lower. So that could also impact the prices as well to the downside in that case.
All right, really appreciate you breaking that down for us, Inez. Thank you so much. Tariffs, as well as President Trump's immigration policy, set to add pressure to the already wary housing market. Yahoo Finance spoke to Jim Tobin, the CEO of the National Association of Home Builders, about the headwinds builders are facing.
We get 30% of our lumber from Canada, and that will certainly crimp our ability to build more houses, but build those houses affordably. Everything is starting to impact, again, tariffs and immigration policy are really starting to squeeze every market in this country.
Joining me now is our very own Claire Boston. And Claire, it is a very unique time to be chatting with you. A lot is changing. I read your story over the weekend about some signs of positivity in the housing market. Now we've got these tariffs officially this morning. How are you thinking about, and how are the people that you speak to thinking about the totality of the impact of this policy?
It is definitely a weird market right now. And on the tariff front, the big thing we are seeing is all of this is probably pointing to higher prices in the new home market. It's not just lumber that we rely on. In Mexico, we import a lot of gypsum, which is used in drywall. And then home appliances, things like your stove, that usually comes from China. And as a result, generally speaking, that would push home prices higher. Builders may respond by trying to build smaller, using less lumber, that kind of thing. It remains to be seen, but probably not good news for the market at this moment.
And how quickly is that read through in price increases for the housing market? Do we know at this point?
Yeah, it's hard to tell right now. The other thing I'm kind of thinking about is the substitute effect. If you are kind of thinking about a new home versus an existing home, maybe you're looking at that existing home if the prices become more comparable.
Sure.
And that kind of thing, potentially could push prices up there as well. And it's just tricky. It's really expensive right now.
And there's also some data showing that home prices are decreasing in certain areas. Can you talk to us about where consumers can find that opportunity?
For sure, yeah. Right now we are seeing it's a little bit more of a buyer's market these days in specific markets, particularly the South and in Florida. Those are places where the home builders have been the most active recently. And so, one thing that remains to be seen is if tariffs really impact them and push up prices, is the South going to get more expensive in the coming months? We'll have to see.
All right, Claire, it's official. I'm moving to Florida then. Thank you so much for joining us. Really appreciate it. We are heading into the spring home buying season. Zillow says the typical down payment is between 3% and 20%, with average home prices over $320,000. That means most potential home buyers need between $10,000 and $60,000 saved up. Here is some advice on how you can boost your savings. We've got David and John Auden-Schneider, the debt-free guys and co-hosts of Living Not So Fabulously. Guys, a pleasure to see both of you. John, let's start with you. What is the biggest way that you want to advise folks listening to reduce their expenses?
Yeah, you just had several guests in a row talk about how everything is getting more expensive for the American consumer. So some of these tips might have been unheard of even 3 months ago, but they're becoming more common today. One advice we have is that you move in with friends or family to offset some of your costs. We have 2 clients who've actually done this. One client of ours was able to save over $10,000 in 1 year by living with his mom and dad. Another recommendation that we have is maybe it's a tight market in most of the country, maybe not in the South or Florida, but now might be a good time to consider selling your current home, putting as much of that profit into a high yield savings account, and waiting until later when you can either buy a bigger home or when the opportunity is more appropriate for you and your family to buy the right size home. In the meantime, maybe live with mom and dad or maybe downsize to something smaller. And then a third suggestion is maybe looking at some of those things that were luxuries once upon a time, maybe cutting those out, like DoorDash and Instacart subscriptions. We're paying anywhere up to $924 a year in subscription services alone.
Yeah, it's really interesting. I always tell people to look at their biggest buckets of expenses and how they can cut that if they're trying to save. So I'm glad that you brought up the great point about housing costs. David, what are you looking at in terms of some ways to save up extra money?
So one of the things is that now is the opportunity, especially with the gig economy, for folks to figure out ways in which they can earn just a little bit of extra money. We're seeing a lot of individuals who are wanting to either pay off debt or are trying to save for a down payment are doing things like freelancing or starting a side gig. We actually know clients of ours who they pet sit through Rover on the weekend and are making somewhere between a couple of hundred to over $1,000 a month. That helps them save for that down payment. The other thing is that if you're getting ready to move, you probably have a lot of stuff you don't necessarily need anymore. So go out on Facebook Marketplace or Craigslist, places like that. Start selling the stuff that you aren't using and put that money aside for your down payment.
Yeah, it's a really great point too. And John, I know you're also monitoring some personal accounting changes you can make so that you can maximize your saving. I love the sound of that. What does that look like?
Yeah, one suggestion is you can adjust your W-4 so that you get more money every paycheck, twice a month or every other week, have you. Just remember that you might have a little different tax bill come the end of the year, so you definitely want to make sure you do the math to make sure it makes sense for you, as well as talking to an accountant. Also, do a strategy that we call send it before you spend it. as soon as your paycheck comes in, go ahead and pay whatever bills you have to pay within that duration of your pay period so that you don't think that you have extra money around that you don't necessarily have to spend. And then finally, there are some amazing cash back and rewards credit cards out there right now. Take advantage of those to the extent that you're able to, but make sure that you remember that somebody's subsidizing all those rewards and you don't want that to be you. So pay your credit card off every single month.
I love that. So well said. David, I also want to get your take just on how much money you should think about having saved before you even pursue the idea of buying a home. What's a good kind of range?
Yeah, I think this really depends. You showed a stat earlier, anywhere between 3 and 20%. But if you're using one of the local or national programs that are for down payment assistance, then look for the guidance that those programs actually provide. In some cases, you may not have to have a down payment at all, depending on that program. If you are looking for a conventional loan, then please find a qualified mortgage broker, whether that be through your local bank, credit union, or even an independent individual. They're going to be able to not only find you the best rate, but they're also going to help match up that down payment to your particular financial needs. But keep in mind that just because they say you can afford it doesn't necessarily mean that you can. We want to keep in mind that there are also other expenses related to owning a home. Insurance is one of the big ones right now that is being talked about, and as you mentioned, in Florida and in the South, especially because of natural disasters.
Yeah, it's important to look at the totality of those costs. A lot to think about. I will continue to be renting in my New York City apartment until I retire and move to Florida someday. But you guys give me hope that I can do it. So thank you so much, John and David. I really appreciate you guys. Thank you. And you can listen to new episodes of Living Not So Fabulously Wednesdays at noon, every single Wednesday at noon Eastern Time. Let's do a quick check of the major averages here. We are seeing a huge sell-off this morning off the back of those Trump tariffs announcements. You can see your S&P 500 down nearly 1.8%, reversing all of the market gains that we saw after the election of President Trump. You've seen the market losing trillions of dollars over that time period. You've got your tech-heavy NASDAQ down about 1.5%, seeing the S&P 500 getting the brunt of those losses today and hovering around its 200-day moving average. If we do see it dipping just below where it's at right now, we could see even more selling as it hits that key technical level, and we see some models triggering even more selling that could happen later into the afternoon as the market continues to digest the impact of these tariffs that it once thought were a negotiation tool. Now we're seeing these tariffs coming into effect. Coming up, AI is already changing the workplace. I'm going to speak with an expert about AI proofing your career next, right here on Wealth to Be Here. It's a big week for the labor market with data. We've got ADP private payrolls out tomorrow and that key February jobs report coming out on Friday. The latest jobless claims data showing initial claims climbing to a 3-month high amid increased layoffs. So how can job seekers navigate the changing job market? Joining me here in studio, we've got Ken Coleman. He is co-host of The Ramsey Show and 3-time best-selling author. Ken, can't imagine a better person to talk to about how to navigate this labor market. On the one hand, we're seeing and hearing from CEOs that I speak to on the show this idea of just slowing down, hiring slowing because there's concern about policy uncertainty. And then you've also got a little bit of competition from the likes of AI. What is your headline on how consumers should approach this job market?
Well, I think you've got to be really diligent to make sure that you've got your connections up to date. There's an old book my dad gave me when I was 17, written by a guy named Harvey McKay. And it was called Dig Your Well Before You're Thirsty. And that is true today as it was back then. The idea here is we have a tightening labor market. You just called that out, and it's absolutely true. Certainly in white-collar jobs. Right. Companies are just sitting back, especially on today's news. You know, I've been watching the show so far. You've been covering this beautifully. So what are people going to do? They're going to kind of wait and see. And so this is a tightening labor market. So polish up the connections. Everybody thinks about polishing up the resume. No, I want to be connecting all the time so that if I get thrown into a large layoff cut and I'm sitting there going, what do I do next? I've got relationships. Relationships are what puts you ahead of the pack if we see more layoffs. Remains to be seen. I wouldn't panic about it. The other thing is always be upskilling. So, you know, you're talking about AI and upskilling. How can I add some more tools to my tool belt? So think of your industry and think of how software AI, how all of that is changing the game. If you are constantly paying attention to that, then you're going to be at the best position possible to be able to react to whatever comes your way.
And what do you say if someone asks you, should I pivot out of my career completely because of AI? How should people think about that choice?
I wouldn't pivot out of it unless you should. Let's take administrative or clerical roles. I think they're the ones on the chopping block. There's no question that if you're an administrative assistant or in some type of administrative customer service role, your job absolutely is in danger with the advances of AI. So what do? Okay, so where will AI spin off new jobs? Be paying attention to that. Every new technology does remove some jobs, but it always spins off new jobs. If you think about 10, 15 years ago, the jobs that didn't exist. So I'm upskilling to say, how can I learn AI?
Right.
Because there's always going to be a need for a human to work with AI. Keep in mind, AI is limited to what a human programs it to do, and many times it needs somebody to help it do what it does. So what does that look like? If you can't find anything, then absolutely be thinking about a trade skill, be thinking about a different industry. Well, for instance, if you're in one of those roles right now, I'd be thinking about electrician, plumber, carpentry work. I mean, that's reality. And we're seeing the younger generation real world skills. The other thing is create a small business. Bring the human touch. So if you've been in clerical administrative work, and you're really good at making sure that the I's are dotted and the T's are crossed, and you're really good with people. So how can you then go into a different world where you're helping real humans do that? This is not glamorous, but I could create a organizing business. I could create a cleaning business. There are ways to go meet needs. So start thinking across the spectrum what your skill set and experience will allow you to do in a different space.
30 seconds left. What's your biggest advice to someone who hears that and says, well, I can't start a small business. I can't do that. What do you say?
It's never been easier. So instead of thinking about this big business that's going to take care of my paycheck, go, what can I try as a side hustle? I get to test. I'm not expending a bunch of time or money to see if I can do this. Start small, grow real slow. You'd be surprised at how easy it is to build a business that'll sustain you.
All right, Ken, amazing advice, and really appreciate you making time for us, breaking down how consumers can prevent from any AI-related risks to their careers and grow potentially their own businesses. Thank you so much to Ken Coleman. We're going to do a quick check on those major averages. Again, we are still seeing significant selling off the back of those 25% tariffs on Canada and Mexico becoming official today. Also, that additional 10% levy on China. You've got your S&P 500 hovering around that 5750 mark, still seeing that selling continuing. We're seeing that the market has erased all of the gains following the election of President Trump. So it'll be interesting to see if we get a response on policy, any more willingness to negotiate off the back of that degree of selling that we are seeing today. Also seeing Target falling after a mixed earnings print. We're going to discuss that retailer's results and the outlook for the consumer after the break. Stay tuned. Let's get a quick check on the markets here. You can see the S&P 500. Just wanted to take a look to show you the degree of selling that we have seen post-election. You can see that huge drop off there. But as we take a look at the market, just intraday today, you've got the S&P 500 hovering down around 1.5%, recovering a bit from the degree of losses that we saw near 10 a.m. this morning. Also, just want to quickly mention here that we are seeing across the sectors a lot of negativity when it comes to individual names here. And you've got your tech-heavy NASDAQ also struggling today off the back of those tariff-related announcements this morning. Now, Target CEO Brian Cornell addressed concerns about tariffs, elevated volatility, consumer spending in the company's earnings call earlier this morning. Take a listen.
The sales decline in February, we reported this morning, reflects a mix of factors. Consumers continue to show a willingness to splurge on newness. Yet, as we've discussed before, persistent economic uncertainty has consumers taking a cautious approach to spending, particularly in discretionary categories.
Cornell also telling CNBC that President Trump's tariffs on Mexico could raise prices on items like strawberries and avocados within days. Here with more, we got Sucharita Kodali, Forrester Research Retail Analyst. Sucharita, it's great to have you on here. So first we had Walmart, then we had Target. How significant and how widespread do you anticipate this slowdown due to policy like tariffs being in the retail space?
Well, there's a question that it's going to affect most of the retail industry through 2025, especially if there isn't any clarity that companies have as to if these tariffs are going to happen for an indefinite period of time, or if simply they're political theater. Because if it is something that is really about having some sort of an impact on fentanyl, or having some sort of an impact that is more near term, like immigration, perhaps these tariffs go away. And if these tariffs go away, then this is less of an issue. But that said, consumer sentiment has been at record lows for some time now. And as long as inflation is over that 2% mark, as long as interest rates are higher than what consumers expect, that consumer sentiment's probably not going to recover.
Yeah, so if we zoom out a little bit before today, was there already a slowdown in consumer spending indicating some economic weakness before these tariffs went into effect? And if so, how does that impact retailers moving forward?
No, there really wasn't much of a slowdown in consumer spending. And really through much of 2024, consumer spending has been at an all-time high. What we've seen is that there was less growth, but there's certainly not been a decline. What we may see in 2025 is actually some decline, particularly if consumers start to trade down, or they choose not to spend because they want to save altogether. Yep. So the retail economy was actually doing quite well through 2024.
So which retail names do you think are safest under a tariff-driven regime for investors listening who want some names?
Well, I don't know that there are necessarily that many that are consumer-facing businesses that are entirely immune, but at the moment, there are a couple of retailers like Aritzia, Urban Outfitters at the moment seem to be doing well. TBD, whether or not that continues. These are all companies that have global manufacturing. And just because we're talking about 3 regions of the world having tariffs doesn't mean that the rest of the world is altogether immune. It seems like there is talk about putting tariffs on every nation at some point, and that will absolutely adversely affect anybody who's manufacturing overseas.
All right, Sucharita, we got to leave it there, but really appreciate you joining us this morning. Thank you so much. We're going to do another quick check of those major averages here. You can still see that selling happening off of the back of those announcements from the Trump administration. I just want to mention some individual sector selling that we are seeing today. Certainly in those retail names that we were discussing with Sucharita, all those retailers, she said, have the chance to be impacted. She said there's not necessarily a lot of stock picks to go around when it comes to retailers that will be insulated from tariffs, though of course you can look at company fundamentals to find some individual stocks that could withstand those headwinds, but still headwinds nonetheless. You've also got a lot of selling happening on those auto names today, the likes of GM, Volkswagen, Mercedes, all trending downward off the back of those 25% tariffs on autos specifically. And then you've got those tariffs on chip stocks weighing on the semiconductor index as well. Coming up, we're going to get tips on optimizing your savings. That's coming up next on Wealth. Sticky inflation persisting in the U.S., and it's showing up when you fill your tank, when you buy your groceries, and when you pay your rent every month. 44% of Americans say inflation impacted their decision to change their current saving strategies, according to a Vanguard survey. So what is the most effective saving strategy for consumers who are trying to withstand the effects of inflation? Joining us with the answer to that, we got Brandon King, head of personal investor cash over at Vanguard. Thank you for joining us, Brandon. So talk to me about the single best way that consumers who are struggling with inflation can start to optimize their savings.
Yeah, and inflation is the hot topic here lately, and there are very real things that investors can control to fight against it. And the biggest one is making sure you're getting your fair share on your savings, right? If you look at your traditional banks, they're earning maybe 41 basis points. That's 0.41%. And with inflation hovering around 3%, you're actually losing money, by not looking for alternatives that can yield a bit more than that, and there are plenty out there. So I would urge investors and savers to shop around and look for better yielding solutions so that they can maximize their returns.
So talk to me about that, because just anecdotally, I know a lot of people who got into the high yield savings account space a couple of years ago, and now their savings account may not be offering the best return. How should consumers be thinking about flipping around and flip-flopping their high yield savings accounts?
Yeah, and rate is one factor. So definitely make sure you're earning a competitive return. And so yields do fluctuate, but we do expect them to be higher for a bit longer. And I think that if you're in a situation where you feel like you're not earning what you deserve, there are plenty of options out there. So you can look around. But at the same time, yield is just one factor, right? And so there's a lot of other reasons to choose a high yield savings account or choose a cash management account or do work with a firm. And that includes access to cash, levels of FDIC insurance, and also the kind of total relationship and potentially simplifying your finances. So, at a place like Vanguard, having your savings, your investing side by side can actually be a really good way to simplify your finances and also kind of manage them holistically.
Yeah, and Brandon, something else you point out that we were fascinated by, a quarter of Gen Z is keeping money in cash, a significant portion of their savings in physical cash. Talk to me about that. Is that an advisable strategy for Gen Z, and why do you think we're seeing that?
Yeah, so I would say no. One, because you're not earning anything, and we just talked a bit about inflation and the impact it can have on your savings. I think some of the reason we're seeing that is many of that generation, they're not really used to earning returns on their cash, right? So if you think about early 2020s and most of the 2010s, interest rates were near zero, and so there wasn't real returns you could earn on your cash. Well, that's not the case today, right? And so I think maybe that generation needs to be activated a bit and really understand that APY and the interest rates of today can actually have a real impact on your cash. And by not taking that action, and with the way inflation is, you're actually losing money.
All right, we got to leave it there. Brandon, thank you so much for joining us. Appreciate it. We're going to do a final check on the markets here. It's interesting to see where we are seeing the degree of this sell-off because it indicates a little bit of that economic slowdown fear in the market. The biggest leaders of losses today, so the biggest losers, are in the financial and consumer-led names. Banks posting a really terrible day so far. That KBW index down 6.3%, the worst day since Silicon Valley Bank crisis happened back in 2023. We saw financials being a huge beneficiary of the Trump trade, so also an example of the unwind of that Trump trade. You've got the Magnificent Seven, those tech-heavy names, down just about 10% over the last 2 weeks, but it's down 15% since its December high, though as you can see on your screen, the Nasdaq's down about 0.8%, so we're not seeing those tech-heavy names be responsible for the majority of the losses. Today, we will continue to monitor the selling going on in the markets. But that's going to be it for Wealth. I'm Madison Mills. Thanks for watching.